If you have a registered retirement income fund, or RRIF, you are required to take money out of that account every year. The amount that you're required to withdraw is based on a certain percentage of the value of the assets on January 1st of that year. Now, the percentage itself is based on your age and it increases over time. The money that you take out of your RRIF account is considered taxable income. So today, I'm here to talk a little bit about how to reduce the tax liability and a few strategies to help reduce taxes. Today, I'm going to talk about a few strategies to help reduce that tax liability that may be applicable to your unique financial situation. Use your younger spouse's age. As you know, your RRIF withdrawals are based on a percentage of the value of your assets on January 1st at the start of each year. The older you are, the higher that percentage is, which means that a larger portion of the account has to come out each year. Now, when you set up your RRIF, you do have the option of selecting your spouse's age if they are younger than you compared to your age. This means that over time, you've locked in a younger age, and so each year you are required to take out less from the account than you otherwise would have been if you used your own age. This, of course, will reduce your tax liability in the current year. Split RRIF income. Money that comes out of your RRIF is considered income. In fact, it's considered pension income, which means that it qualifies for pension income splitting. This means that if you're 65 or older, you can split up to 50% of your RRIF income with your lower income earning spouse, which will ultimately reduce your combined tax bill for the year. Trigger the pension income tax credit. This is a strategy that you can implement starting at age 65 when you don't actually need the RRIF income. To put this strategy into practice, you can open up a RRIF, or registered retirement income fund, and fund it using a certain amount of money from your registered retirement savings plan. Ultimately, you want to put enough into this new RRIF account that will allow you to redeem $2,000 a year from this new RRIF between the ages of 65 and 71. When you take the $2,000 out each year, this will qualify for a 15% annual tax credit on your tax return. Customize withdrawal amounts. Determining your optimal RRIF withdrawal amounts is really dependent on your own unique financial situation and takes into things like your age, your tax status, your marital status, and whether or not you have other sources of income. When starting to take RRIF withdrawals, it's really important to map out and figure out how much you'll need every year and perhaps what the tax implications of those withdrawals are going to be. For some people, it might make sense to only take out the minimum amount each year because they have other sources of income and they want to keep their tax bill low. For others, it might make sense to take larger withdrawals earlier on because they need the cash or they want to reduce their final tax estate liability. Plan initial spousal RRIF withdrawals. The timing of withdrawals is really important when we start to look at spousal RSPs and spousal RRIFs. The reason for this is that if you're making a withdrawal from this type of account within 2 calendar years of making the contribution in the first place, some of that income from that withdrawal could be attributed back to you, the contributor. Also, for spousal RRIFs, any withdrawals that exceed the minimum required withdrawal amount, again, could be attributed back to you, the original contributor. Use your tax-free savings account. If you find yourself in a situation where you're required to take money out of your RRIF account, but you don't actually need the income, you could consider doing things like using some of your RRIF withdrawal for the purpose of making a tax-free savings account contribution. Yes, you will pay tax on that withdrawal when you take it out of your RRIF, but at least now you have the option to put the money back into a tax sheltered investment account. If you believe that you could be applying some of these strategies to your own RRIF account but are not totally sure how to go about doing that, our team at Ferguson Financial Planning would be happy to assist, and you can schedule a consultation with us using the link below. Please check back to our website. We post regular market commentary, and don't forget to like, subscribe, or comment if you found this information useful. Thank you for watching.